This week's episode is brought to you by Capital Financial Advisory Group for all your retirement needs.
Broadcasting from coast to coast, it's the Financial Safari with your host, Coach Pete D'Arruda. You'll hear from some of the nation's top financial professionals. So stick around and find out how to make it through the jungle of the financial world, right here on the Financial Safari.
Coming up on the Financial Safari, Parker dives into the many sides of risk in retirement. Then in the radio studio, Coach reminds us there is risk involved in interest rates. Leanne shares why many women are conservative with finances. Then Marty explains the retirement red zone. But first, let's check in with Coach Pete and Chuck in the TV studio.
Welcome once again to the Financial Safari. I'm Chuck Caton along with Coach Pete D'Arruda, and we are here to try to educate and have a lot of fun, really, and talk about retirement planning for you. And we want to make it fun because at Capital Financial, that's what we're all about. Because it's really fun, Coach, when you've got enough money for retirement, you know you've got the peace of mind. You call it SWAN, right? Sleep well at night.
Makes a lot of sense, Chuck.
Absolutely it does. And you look dapper here today. I love that colorful suit. Where'd you get that one?
Chuck, I'm president of the International Association of Registered Financial Consultants. I was in Chicago a few months back speaking to the big group of financial advisors from across the world. And you know, when they have the speeches and the events, they also have break time, and then they have all the advisors mingle around all these booths that are set up there, get refreshments, find out about all the different strategies that exist in the financial world. And then there's a little booth in the corner, a guy named Ranzini from Italy. He would measure you, and you could buy custom sport coats and suits from him. So guess what I let him do? Let him measure me.
There you go.
and it fits perfectly. This is real good Italian leather. It's really nice. And Chuck, the correlation between how good I feel wearing a nice suit and how good a lot of people feel when they have a proper retirement strategy that's customized for them is parallel. It is amazing how good you feel when things work like they should. They used to say it on the A-team. Hannibal would say, I love it when a plan comes together.
Absolutely. Right? And when we speak of color, I always think of a stoplight. Yeah. There's a red light, a yellow light, and a green light.
Right.
But you make retirement planning so simple when somebody sits down with you or a member of your team that there's a red, a yellow, and a green in retirement planning. Please explain.
And we've broken it down to 3 colors, the colors of retirement planning. And Chuck, it's pretty simple, and it's not like this advice we're giving right now is not customized to you. You need to get a true plan and look at, number one, see where you are right now, and number 2, see if anything needs to change to get you where you think you're going to be in retirement. So retirement planning is all about looking at the road you're on now, making sure that road that you're on now that you think is going to take you to the right place is really going to take you to the right place. It's a satellite view down. 3 colors we use. Red. Now, red means risk. Nothing wrong with risk, Chuck, but just have to know as you get older and get close to that financial red zone, which I consider 52 and above, we need to make sure we have less money at risk and more money in a place we can't lose. Now, risk accounts, the red accounts are stock markets, mutual funds, ETFs, real estate, believe it or not, goes up and down.
Right.
Another overlooked factor of real estate is each and every year you get taxed on the value of that real estate. And if you don't pay the tax, the government comes and takes it and auctions it off. The hidden fee of real estate, and if you're in a county that raises taxes every year, that's a compounded tax. Wake County, North Carolina, 10% tax increase, real estate tax increase 2 years ago.
Yeah.
This year, another 10% tax increase. So compounded on top of each other, 20% more taxes. A lot of people are getting more and more trouble now because they can't afford to pay the taxes. So that's red. Don't say, Coach Pete, I'm fine. I've got all my money in real estate. I'm going to manage this and I'm going to rent property out and retirements. That's going to be my retirement income. Might not work. You might be taxed out of that property. You might not be able to get people into property, and you might not be able to sell that property for what you paid for it. So be very, very careful with that. Now, yellow money is money that is immediately liquid. It's a bank account. You can go down with your card, take the money out anytime you want. But the problem with yellow accounts is they don't grow money. You can't grow money much at all, if any. It's almost under the pillow type account. It's there when you need it, but it's not going to be any more than what you need.
You call that losing money safely.
Losing money safely. Good job, Chuck. And then green accounts, the most important account as we get close to age 52 and beyond. gives you growth when you don't need the money. It protects the money from the ups and downs, well, from the downs of the market. You can't lose money in the green account if set up properly. And then when you decide, you get a lifetime income you can never outlive. I call it the financial fill-up strategy. That's what a green account does. So Chuck, the proper balance of all three of these accounts, more into the green, in my opinion, as we get closer to retirement, more in the red when we're far away from retirement. As long as we can withstand the ups and downs, the ebbs and flows of the market, we could have money in the red account. But Chuck, I've seen way too many people not retire when they thought they were going to retire, or not being able to ever retire because they never learned about the green account. They never had a lifetime income strategy put in place. And the blame for that falls on the broker or financial planner who sold them the investments just to make commissions. And they didn't want to let them go to the green account because their commissions would disappear if people moved from the red to the green. We are a fiduciary planning firm, Chuck. And the most important thing we can do for you is sit down and let's diagram where you are right now. That's the hardest part people have, is looking at their statements and having the statement translated into red, green, yellow. That's a $1,000 process we've seen a lot of people charge. Chuck, we're going to waive that fee for the next 20 people who call. We're going to do your very own bucketing strategy, going through the colors of money, making sure you have retirement TSA built into your account where you can't lose money for retirement, and you have that lifetime income that could increase all the way through your retirement. Chuck, the next 20 people call, we're going to waive our fees. We're also going to give you a 3-book set and a box set on the 401k when you call right now.
All right, and that number is 888-910-8265. That's 888-910-8265, or you can text BREEZE to 21,000. We'll be back in a moment with more here on the Financial Safari.
And time once again for Planning with Parker. We've got Parker Holland here, of course, because he is the Parker of Planning with Parker.
There we go.
That makes sense, right? So one of the things we've been talking about is risk, because there is always risk in in retirement and retirement planning. So my question to you then is, can there be too much as too little risk?
A lot of people don't realize there's kind of two sides of that ball there. And it's kind of like driving. I mean, everyone forgets you can always get a ticket for going too slow, just like you can get one for going too fast. And that can be as dangerous as possibly speeding. A lot of people don't realize there are ways to scale down risk, to be more conservative, without giving up the upside, without giving up control. And they just don't know their options because they've never been told them, or they don't know what to ask, or their current planner or advisor only can do one of certain things.
So when it comes to risk, obviously the older we get, the less risk we should have, but at the same time, we still need some risk.
Exactly. A lot of people come into, and their biggest concern is, I'm getting close to retirement, or I'm in retirement the first few years, and I don't want to give up my growth, but I also feel like I don't have time to play catch up or take risk. And that's 100% true. But just the vice versa of that is, if you're taking money out, you're paying yourself in retirement, you need to replenish that. You need to keep the account growing, so you're taking the icing off the cake, not going into principal. And we need to find a way to play both sides. You got to be able to straddle the I hope so of upside potential and risk, but also the I know so of the guarantees in retirement.
That's comforting, I think, to folks, isn't it?
You can play both sides. And
so what if you were not as ambitious a saver as you might have been, and so then the inclination is to say, okay, I don't care if I'm 62, I'm going to go ahead and make a lot of risk. That's not necessarily the best way.
You don't need to try to jump a gap by, like you just mentioned, just going more aggressive, or coach always calls swinging for the fence. You don't need to do that. There are ways to help save or build up that buffer without having to put everything in the red or risky bucket, so to speak.
And that's important too, but that's one of the discussions that you have with people every day, is managing that, and walking that delicate line.
And it's all personable, and I always say, give us a call, set up your own plan, because we can always talk, we can go into details, we can show you how it works, but it doesn't mean it's best or what works for you. And there's a lot of moving parts. People focus just on the 401k when they might have a pre-existing retirement account or investment account or something, or they have a pension, so they're not as worried about the 401k, or they just think they're just going to rely on Social Security. If that's what you're doing, definitely need to sit down and talk to somebody.
So yeah, I mean, Social Security is certainly an integral part of the plan, but it's not the be-all.
It's not the foundation of the plan. On maximization, there's 1,000 ways to make sure it's working best for you and your spouse, but it should not and cannot be the only thing you rely on in retirement.
And that's it for Planning with Parker. Be sure and stay tuned. There's lots more Financial Safari just ahead. Many people have thought much about lately, and that's interest rate risk. I mean, I know I was buying my first house back in the early 1980s, and interest rates were way high, so you had to deal with that.
This is going to be particularly painful for people that are investing in bonds, especially bond funds, because as interest rates go up, bond prices go down. So your bond's worth less and less.
Well, that's a teeter-totter right there.
You think about a seesaw. So usually when interest rates are high, bond rates are low. Well, interest rates have been low. Bond rates haven't been that high either. So as interest rates start to go up, the bond prices are going to go. They're going to go down. It's not going to be good. So it's going to be, if you're depending on that for income and retirement, you're going to be in a little trouble. So we don't like bond funds right now. And we haven't liked them for a while.
Well, exactly. And that's why it's important to sit down with somebody like you to figure it out. Inflation risk, and again,
things are getting more expensive.
We all know about that.
Think about what you paid for your first house, and now think about what you paid for your last car. Now, the older you are, the more you paid for your the last car compared to your first house.
Yeah, they're very close.
Yeah. My dad, $34,000 for his first house, 3-bedroom, 2-bath ranch in Laurinburg, North Carolina, about 1,400 square feet. Just bought a car for $60,000 the other day, a pickup truck.
Wow.
So he almost paid double for the last car that he did the first house, and that was back in 1974 when he bought the house. So that's just how expensive things are getting.
Incredible.
And you can't get
around
around
it. Well, you need your money to grow faster than inflation. That's what it comes down to. And there are ways. It's not putting it in the bank is losing money safely. There, you're not gonna perform up to inflation aspects if you have money in the bank account.
No,
but you don't need to take a bunch of risk either, Steve.
Right,
so that's important.
Exactly. So the next thing and this is something I know you talk to folks about every day, and that's longevity risk. And you really have to look at this one.
The risk of living too long.
Well, but it is.
I never look at my life as living too long, but I know what you're saying. You could run out of money if you don't have money put aside for the future you who could live to be 121 or whatever. We do all our plans in our office to at least 121. That's how far we illustrate them, but they'll go forever for income if you live longer than that. But 121, I think I'd be pretty happy if I got to 120.
I'd be happy at 120.
If we can cancel longevity risk off the chart, if we get to 121.
Want to hear more? Head on over to financialsafari.tv or follow the Financial Safari on your favorite podcast app for new shows every week. Take advantage of meeting with a professional who will create a one-page financial review that will indicate if you're in need of a full-blown financial plan. Take the mystery out of financial planning by mapping out where you are now. Call 888-910-8265, 888-910-8265, or text BREEZE to 21,000. That's BREEZE to 21,000.
Hello again, everyone. Chuck Caton here. Women and Money is the topic here with Leanne DiMartino, who is income analyst with Capital Financial. And we're talking about this little pamphlet, which has a lot of different challenges that women undergo when it comes to the financial world, the retirement world. We have covered things like divorce. We have covered things like becoming a widow, unfortunately, and that's something that you can never predict. But there are other challenges too, and there are also things, Leanne, that we may or may not know about women. For example, you've taught me something off camera, saying that most women, when it comes to finances, are very conservative. Please explain.
They are very conservative. They feel like they're not educated enough about the financial world, so therefore they're more conservative investors. They're afraid of the risk. So if you're not taking, especially in the beginning of their 401k saving years, if they're not taking enough risk, they're not gaining or earning as much as maybe a man might be.
Now, that's just a matter of education, and that's where you come in, right? When they come in and visit you, a lady can come and say, am I doing the right things with my 401k? If she's a working mom or a working single woman in a relationship, and you can give them the great advice to do it depending on their age, because I know there's something called the rule of 100 that we have to think about.
Yes, the rule of 100 is the closer we get to retirement, we need to start peeling away more towards a protected account. One thing we do offer here is a complementary portfolio analysis. So if they want us to take those statements from that 401k and get one of those analysis for them, it'll kind of give them a comparison of how they need to invest.
All right, now we talk about that rule of 100. That means the younger you are, the quicker you get in to see Leanne, the more risk you're able to take because you got more time to recover. And as you do get older, say my age or so, maybe you want to do 25 or 30% and scale back on the risk. But these are the challenges, but I still don't get it. I have to tell you that for the number of shoes that I know that my wife buys, you're trying to tell me that a lot of women are conservative with investments. I'm still
they're just they're very, very risk adverse.
Absolutely.
They are very risk adverse.
Well, you can do something about that too. Those are the many challenges, and this booklet can help you out. All you have to do is come in and see Leanne here at Capital Financial. Women and Money is our segment, and it is tailored for you. Leanne has seen a lot of different situations among women and finances and investments, so she can help you. This has been Women and Money. I'm Chuck Caton for Leanne DiMartino. Thank you for watching and listening, and we'll be back with more in a moment.
Talk to one of our local experts. We have a special offer for you on today's show. Call in the next 30 minutes and we'll custom design for you an easy to understand financial review. It'll indicate if you're in need of a full-blown financial plan. There's no obligation or cost for this initial review for all callers who have at least $200,000 saved for retirement. If you meet these qualifications, here's what you can expect. First, we'll run a fee report to help you understand what it's costing you to work with your current planner or advisor. We'll show you how to protect your investments and keep more of your money in your accounts. Next, we'll perform a tax analysis to show you how you could possibly be reducing your taxes and increasing your cash flow. And finally, we'll create a customized lifetime income plan using proven strategies and techniques that could turbocharge your retirement income. In short, we'll take the guesswork out of financial planning for you. So for all who call in the next 30 minutes, a comprehensive financial review that we're offering with no obligation. Just call the number below right now.
Back on a Financial Safari, I'm Chuck Caton, and now it's time for our segment, Money with Marty Hensley of Capital Financial. And remember, he's a true fiduciary who has your best interest in mind, and I'm always excited to hear from near retirees and retirees some of their concerns. And I'm sure it's run the gamut, Marty, for you. What are some of the more common questions people have as they approach retirement or are just entering retirement?
That's a great question, Chuck. We have, in our world over at Capital Financial, we believe anyone that is 10 years or less to retirement or in retirement is in the retirement red zone, right? And there's some very important questions that people should ask themselves when they're in that retirement red zone. I've just jotted down a few here that folks should really, if they really want to think about what they're currently doing for retirement, these are some questions that folks should potentially be asking themselves. Is this account for gambling? Or is it for your retirement needs? You know, we have some clients that come in and they'll say, you know, Marty, I've got this little account over here. It's a stock trading account, you know, and if I lose some money, if I win some money, you know, make some money, it's not that big a deal. We consider that a gambling account, but that's not an account that I'm going to rely on to provide me a safe, reliable, predictable income in retirement. You know, that's what we call some funny money at that point. So that's something that one needs to ask themselves. Is this an account that is for my true retirement, or is this kind of play money without a better use of the term? Another one is, are you aware of the risk associated with the accounts that you currently have in place for retirement? Do you understand the risk that goes along with bonds or bond funds? If you have a variable annuity, are you worried or concerned about the risk and expenses associated with a variable annuity?
Yeah, and that's one of those that I think a lot of people have to be very wary of.
That's exactly right. Another one is, how important is it to you that you would leave a portion of this retirement or all of this retirement account to an heir, or what we call a legacy? How important is that? Do you have that protection for a spouse, children, grandchildren? Is that important to you? Mm-hmm. If you do not have children, or if you do not have grandchildren, maybe it's a church or charity that you're interested in leaving that money to at some point. Another one that you would want to ask yourself, would it be a big concern if your account were to drop in value by 20% or more?
That's right, and corrections possibly coming, so you've got to prepare. And are you nervous about that?
That is exactly right.
And so finally, what do you think? What's another good question to wrap it up?
Another good question is, is it important that you recover from these losses? We have a loss, it's on paper. How important it is to recover those losses and get back to the value of where the account was before. That's also very important. These are all questions that we ask ourselves, and these are all questions that we answer for our prospects and clients. That's why we are the true fiduciary, and we have got a great tool here. 7 reasons successful investors choose fiduciaries. We'd love to get you into our office, and we'd love to share this booklet with you and talk about what a true fiduciary can truly do for you as a potential retiree.
And they represent you, and they have your best interest in mind, just like Marty Hensley does here at Capital Financial. This has been Money with Marty here on the Financial Safari. I'm Chuck Caton.
How much money can you afford to lose? That's the big question. Every person I sit in front of, I ask them, how much money are you willing to lose? And they say, none, absolutely none. Then I look at their finances and they are 95% in the red bucket, which can lose money. Hi, my name is Greg Berrien, and I proudly serve the Wilmington community for Capital Financial, and we want to employ the bucket strategy for you so you don't lose money in your retirement.
Call 888-910-8265, 888-910-8265, or text BREEZE to 21,000. That's BREEZE to 21,000.
Welcome back to the Financial Safari. I'm Chuck Caton, Coach Pete. Once again, the colorful Coach Pete. I'm having so much fun doing these segments right now. You make it go so quickly. Your staff is so expert. They are true professionals. And, that's what a true fiduciary does for his clients.
A lot of people are uncomfortable about financial planning, Chuck, because they're intimidated by the financial planner, or they're afraid that they won't stack up like everyone else. But, folks, the number one thing you can do is stop worrying and get started in the right direction as soon as possible. There's no day like today, a better day than yesterday, or a better day than tomorrow, let's say.
Right.
But let's get started as soon as possible. And Chuck, it's not as complex as a lot of people think it is to get a true plan put together. And the number one thing you need to do, in my opinion, is work with a fiduciary planning team and firm who specializes in that leg of the relay race that gets you all the way through retirement, not just to retirement, which a lot of planning firms do. Hey, we'll get you to retirement. After that, it's up to you. We'll be retired then anyway, so we don't care. No, we have a full firm. Our plans are designed to be what we call retirement autopilot. Even if we're not here, your plan will continue to go exactly as we said it would.
Absolutely. Now, that is not the scary part, because when you will have true comfort when you come and see Coach Pete and the team at Capital Financial. But I'll tell you what's scary. It's the stock market. And you've talked about fact-checking Wall Street.
Yeah.
Now, why should we do this, and what do you mean by that?
Well, there's a big difference between fact and fiction, isn't there?
Absolutely.
Yeah.
You have it in books, and you have it in real life.
The hardest part for me, Chuck, when I was growing up, probably 3rd or 4th grade, was distinguishing in my head and getting straight the difference between fiction and nonfiction. I always thought fiction was the truth and then nonfiction would be not the truth. Right. But fiction is a fable and nonfiction is the truth. And so we deal with nonfiction type accounts. But unfortunately, when you think about some of the brochures I've seen over my lifetime, and I'm sure you've seen them too.
Oh, absolutely.
Related to Wall Street, a lot of times they're using fables because they're saying, hey, just put your money in our stock accounts because the last 10 years it's done this. Chuck, does the last 10 years matter to you if you're just getting in something today?
No, not at all. It's just like a team that went on a 10-game winning streak in any sport, but it's what have you done for me lately? Yeah. Who cares what happened 10 games ago? It's the next game that's so important, or the next couple.
I had a buddy in high school who had the best Camaro ever. I made friends with him so I could ride around that Camaro. And then he'd come back in college, we'd hang around, and still had the Camaro. Chuck, about 5 years after college, the Camaro was in cinder blocks in the backyard. So the 10 years that I knew him having that car was great. But if he sold the car to somebody else saying, hey, I had this car for 10 years, it's been the best car ever, you should buy it today, they're buying a used piece of junk. So we have to be careful with the way product brochures are designed to entice you to get in when you don't have a true plan. So the problem with I see about Wall Street is it's all about let's grow your money, give us your money, let's grow your money. And if they grow your money, they're making money off your money. You've heard the commercial, when you do well, we do well.
Yeah.
But they forget part two. When you don't do well, we still do well because we're making money out of your money. If you're dealing with a planner who is taking money out of your account, you need to exactly know why. Sometimes it's reasonable, like paying a planning fee or a money under assets under management fee. But right. Chuck, if you are paying and don't know what you're getting or having commissions taken out of your money every single quarter, you need to know what that money's about. So that's what we call fact-checking Wall Street. What are you paying? And is what I'm paying worth what I'm paying? And if you have a value, Chuck, I'd gladly pay somebody 1% to get me 15%, and then maybe say there's an account that has a 0% fee, and you're only getting 1% interest. Which one would you want? I'd rather pay 1% and get 15. Now
Absolutely.
That's I'm just pulling that number out of my hat. There might not even be an account like that. I know CDs at a bank have no fee, but they only give you 1% if you're lucky, maybe 2%. So it's all about looking at the net gain you get. And unfortunately, with a lot of Wall Street accounts, we see net gains a lot less than what people thought they were going to get based on the fact that the brochure or the salesperson was using past performance to try to guarantee future results. That is absolute fiction and not allowed, and I call baloney on when I see that. So it's about getting a right plan in place. That's why we say fact check Wall Street. But folks, more importantly, fact check what you have. Do what we call retirement TSA. Let's bring what you have in. Let's put it on our conveyor belt. Let's put it through that X-ray and MRI machine. Let's see what you really have. Let's do the red, green, yellow strategy there. Let's look at what you have in red accounts, money that can go up and down, that could be gone, that could be feed. Let's look at the yellow accounts, money you can get to right away, but doesn't earn much. And then let's look at the green accounts, the accounts that give you protection, the accounts that give you some growth, and then lifetime income you can never outlive. Let's make sure you have that proper combination of those different three colors based on your age. And Chuck, it's not as hard to do as you think. Folks, the hardest part of this whole process is you picking up the phone or you texting right now and saying you want to get started because you're wondering. A lot of times people won't do it because they're wondering what the zinger is. If you are, one of the next 10 people call, there'll be no fee and no obligation to put together your very own customized plan that we've seen others charge $1,000 to $2,000 for. Chuck, we're going to waive those fees if you call right now.
And all you have to do is call 888-910-8265. That's 888-910-8265. Or, as Coach says, text us. Text BREEZE to 21,000. That's BREEZE to 21,000. This has been another wonderful show here on Financial Safari, Coach.
And folks, you can have your own plan done for you at any time. All you have to do is call us. We'll see you next week, though, right here on the Financial Safari.